Most investors know they are going to pass before your pitch ends. Not because the idea is bad, not because the market is too small, not because you use the wrong slide template. They pass because the risk is unclear, and if you do not know what uncertainty they are reacting to, you will keep improving the pitch while leaving the real problem untouched. Founders think pitching is about explaining the idea. Investors are listening for risk. The investor question is not, is this interesting? The real question is, what would have to be true for this to work, and how much of that is already proven? This is why a pitch can sound polished and still feel unfundable. Investors fund certainty, not ideas. Certainty does not mean everything is solved. It means the biggest risks are named, reduced, and backed by evidence. A founder who understands risk feels investable. A founder who only sells upside feels dangerous. The more you avoid the risk, the more the investor focuses on it. When an investor listens to your pitch, they aren't just hearing your idea. They're running a silent, subconscious risk assessment. They are scanning for certainty. To help you understand their mindset, I want to introduce a framework I call the certainty stack. It's a 5-layer model that represents the 5 critical questions every investor needs answered before they can confidently write a check. Master these 5 areas, and you'll be speaking their language. Let's break them down, one by one. First, and most importantly, is buyer certainty. The question isn't who could use this, it's who specifically will buy this first. Investors dread hearing that a product is for everyone or for small businesses. That's a red flag for a lack of focus. You must be able to describe your initial customer with painful specificity. Think of them as your beachhead market. For example, not just restaurants, but independent coffee shops in urban centers with fewer than 5 employees. This precision demonstrates you have a real, actionable go-to-market plan. Next is pain certainty. Is the problem you're solving a vitamin, a nice-to-have, or a painkiller? A must-have. Investors fund painkillers. The key here is urgency and cost. Is this problem so acute that your specific buyer is actively trying to solve it right now? And what is it costing them? This cost isn't always direct dollars. It could be wasted time, compliance risk, lost customers, or employee burnout. If you can say, our target buyer loses 10 hours a week on this, which costs them $5,000 a year in lost productivity, you've established clear, quantifiable pain. Third, we have proof certainty. An idea is worthless without evidence. The question is, what evidence exists today that you are on the right track? This doesn't mean you need a perfect finished product. Proof can take many forms. The best proof is revenue and paying customers. But early on, it could be a functional prototype that solves the core problem. It could be a handful of signed letters of intent, LOIs, from your target buyers. It could even be a waiting list of 500 people who fit your ideal customer profile. You must present tangible evidence that your solution is desired. Fourth is distribution certainty. It's a fantastic start to have 1 or 2 customers, but how will you get the next 100 and then the next 1,000? The question is, how do you reach your specific buyer repeatedly and scalably? Relying on your personal network is not a scalable channel. You need to show you've identified a machine that you can put $1 into and get more than $1 out. This could be through targeted digital ads, a content marketing strategy that attracts your buyer via SEO, or a direct sales process that is proven to work. Investors need to see a clear, repeatable path to customer acquisition. Finally, there's timing certainty. Why is your solution viable right now? Great ideas often fail because they are too early or too late. You must anchor your pitch in the present. What specific shift in the world makes your success inevitable today? This could be a technological enabler, like the mass adoption of 5G or the recent accessibility of large language models. It could be a regulatory change that creates a new compliance need, or it could be a cultural shift, like the move to remote work or a growing demand for sustainable products. You must answer the question, why now? These 5 certainties are a stack for a reason. Each layer builds upon the one below it. A weak answer in any one of these areas creates significant investor hesitation because it compromises the entire structure. And it all starts at the bottom. If you cannot name your first buyer with absolute precision, the rest of your pitch becomes a house of cards. Your claims about their pain are unverified, your proof is irrelevant, and your distribution strategy is unfocused. It all becomes theoretical. I put this into a simple 2-page checklist called the Certainty Stack. It lets you score your startup across buyer certainty, pain certainty, proof certainty, distribution certainty, and timing certainty. You can get it from the link in the description. Keep it short. Return immediately to the content. Why good ideas still get passed on. Interesting idea, unclear buyer. Strong technology, weak urgency. Big market, no proof. Good story, vague distribution. Smart founder, no clear why now. Investors are not only evaluating upside, they are evaluating how much guessing they have to do. Every vague answer forces the investor to do the work you should have done before the meeting. So, what does fundable positioning actually sound like? It's more than just a catchy tagline or a mission statement. For an investor, your positioning is the first and most critical signal of your venture's viability. It's a direct reflection of the clarity of your thinking. Vague ideas are seen as high-risk bets, while sharply defined plans are seen as calculated investments. Investors aren't just funding a product, they're funding a well-defined strategy to conquer a specific market. Your positioning statement is the opening argument for why your strategy is the right one. It needs to immediately build confidence and reduce the perceived risk of their investment. To understand this, let's contrast a weak positioning statement with a strong one. The difference isn't subtle, it's the difference between a founder who has a fuzzy idea and a founder who has a concrete plan. A weak statement forces an investor to ask a dozen follow-up questions just to understand the basics. A strong statement answers those questions before they're even asked. Here's a classic example of a weak and therefore risky positioning statement. We help businesses use AI to improve operations. An investor hears this and immediately sees red flags. Which businesses? A Fortune 500 company or a local coffee shop? What does improve operations even mean? Is that a 1% efficiency gain or a 50% cost reduction? And use AI is so broad it's meaningless. This statement creates more questions than answers, signaling that the founder hasn't yet done the hard work of defining a specific market, a specific buyer, or a specific problem. It screams market risk, execution risk, and a long, expensive journey to find product-market fit. Now let's look at a much stronger, fundable version. We help regional healthcare clinics reduce denied claims by identifying documentation gaps before submission. The first buyer is the revenue cycle director. The pain is measurable because denials delay cash flow and increase admin cost. This is a world apart. It provides what investors crave: certainty. Let's break it down. First, it establishes certainty of buyer, regional healthcare clinics, and specifically, the revenue cycle director. We know exactly who to sell to. Second, it establishes certainty of pain. Reduce denied claims. This isn't a vague improvement, it's a direct attack on a costly, urgent problem. The pain is measurable in delayed cash flow and wasted administrative hours. An investor can immediately see the business case. This statement doesn't just describe a product, it outlines a clear, defensible beachhead market. The second version is not just clearer, it fundamentally reduces risk. It demonstrates that the founder understands the customer's world, speaks their language, and has a credible plan to enter the market. It transforms the conversation from "what do you do?" to "how does your solution work?" This is the pivot from a speculative idea to a tangible investment opportunity. Remember this: clarity is not decoration. In the eyes of an investor, clarity is risk reduction. Section 6, the practical test. Ask the viewer to score their startup. Can you name the exact first buyer? Can you describe the cost of the pain? Can you show evidence that the problem is real? Can you explain how you repeatedly reach buyers? Can you explain why now? If any answer is vague, that is where investors will hesitate. Investors do not fund ideas, they fund certainty. The job of the pitch is not to sound exciting. The job of the pitch is to make the opportunity feel less risky. We've covered a lot of ground today, all centered on one critical theme: de-risking your startup in the eyes of an investor. We've walked through the 5 pillars of certainty: buyer, pain, proof, distribution, and timing. Each one is a link in a chain, and any single weak link can cause an investor to walk away. The difference between a no and a yes often comes down to how well you can prove you've systematically eliminated risk from your venture. But theory is one thing, practical application is another. How do you actually measure your progress and see your startup through an investor's lens? That's the crucial next step. Before you even think about sending another email or stepping into another pitch meeting, I want you to take a concrete action. I've created a tool called the Certainty Stack. It's a free, interactive scorecard designed to give you an immediate, unbiased assessment of your startup's fundability. It walks you through the exact same 5 certainties we discussed, forcing you to confront the hard questions and evaluate the evidence you have for each. Is your buyer profile truly specific? Is the pain point a hair-on-fire problem or just a mild inconvenience? Do you have tangible proof that your solution works? This isn't just a quiz, it's a diagnostic tool. It will give you a score that reflects precisely how an investor will perceive your current level of risk. The link is waiting for you in the description and the pinned comment. Don't guess where you stand. Know where you stand. Now for some of you, that score might be a wake-up call. You might see exactly where the gaps are but feel unsure about the best way to fix them. If you want a deeper, personalized breakdown and a strategic partner to help you close those gaps, I offer a service called the Fundability Audit. This is where we go beyond the scorecard. This is a one-on-one deep dive where I personally review your pitch deck, your business model, and your evidence. I will show you with surgical precision where the risk in your venture is still too high for an investor to stomach. We'll analyze what investors are really hearing when you pitch, not just the words you say, but the subtext, the assumptions, and the unspoken red flags they are trained to spot. Most importantly, we'll build a clear, actionable roadmap detailing what to fix before you pitch again, apply for that crucial grant, or pursue a major enterprise contract. The goal of the audit isn't just to point out flaws, it's to give you a step-by-step plan to transform those weaknesses into strengths, turning investor objections into points of certainty. If you're ready for that level of intensive, focused guidance, you can learn more and apply for a fundability audit through the second link in the description. Finally, a quick disclaimer. All the content in this video, along with the tools and services mentioned, is for educational and informational purposes only. It is not intended as, and should not be understood or construed as, financial investment or legal advice. Always consult with a professional before making any major business or financial decisions. Thank you for investing your time with me today. Now go out there and build something certain.